Getting split ready.
Getting split ready.
For my wife, God rest her soul.
Oh God, I'm so sorry.
No, she's not dead. We're just divorced.
Unscripted and honest discussions on divorce and separation.
Getting split ready.
What was I supposed to tell him? I divorced you from the show?
Here's your hosts, Doug Katz and Mariah Pleasant.
So if we have the real estate market hot as hot can be, what's the lending market like, Doug?
You know, great segue, because I think that they go hand in hand, and it is, exceptionally good. Rates are low. They're not at the lowest point they've been, but people who try and time the market are crazy. And in a lot of what Julius was saying, there's a lot of good timing right now in doing something. On the divorce side, I tell people if they're refinancing, I don't know what they would be waiting for, because values should never be higher than they are now and rates would never be lower. So fundamentally, you might get a better loan to value than you typically would. You may be able to drop mortgage insurance. Like, it is an exceptional time. And people, I heard the term benevolent procrastination the other day, and I loved it. But procrastination isn't always benevolent. So it's definitely an interesting time. I think that when I hear people talk about they're going to stay low, I do believe that, but not as low as they've been at its lowest point.
So one of the hot questions that I keep getting is for those people who did take advantage of the forbearance.
Yep.
I think a lot of people assume that once they take advantage of that, they're unable to refinance for quite some time. I know probably every lender has their own rules, but what are the general parameters of that?
Well, it's interesting. It varies. And I actually wrote an article for our blog about it. But the challenge is forbearance has always existed. And I think people think it's something new. But, if someone had been in a divorce before and they were in a situation where now there's two households and the income situation is a little bit questionable, contrary to what people think, the banks and the lenders and servicers don't want your house. So if you call them up and say, I have a hardship, and can document that hardship, then typically they'll grant forbearance under certain circumstances for you to get on your feet again. What happened with COVID was the basis for doing it was obvious, and it impacted everybody. So in an attempt to avert disaster, and I think it was probably the right thing to do, they just granted blanket forbearance. And the system was never meant to deal with 40 to 50% or whatever the crazy number is of the mortgages out there to be in forbearance and not paying.
Is it really that high?
I believe it was between 40 and 50 is what I had read.
Crazy. Yeah, that's a lot.
But I think it was, for some people, they took it strategically, because unlike most life milestones where you're like, oh crap, I'm in a divorce, let's say, well, you weren't planning necessarily for the divorce. With COVID, I think people were looking and saying, my job isn't impacted now, but it may be impacted in 6 months or 8 months or whatever. So I'm going to take forbearance and bank that money in case I later need to make a payment. And that wasn't necessarily wrong, because it was an opportunity given. Now, with respect to refinancing, different lenders have interpreted the guidance differently. What you typically see out there is a requirement for either 3 to 6 months of documented post-forbearance payments. Now, some servicers have basically said, hey, we'll just tack it on the back. Don't change. They didn't change anything at all. Ultimately, the note, your mortgage note, what you agreed to pay doesn't change. And that, that was the timer I said. Sorry about that. I guess my coffee's done. There's no change. So the minute they get off forbearance and it starts to be documented that they're paying, it would be from there. Other lenders are looking at it and saying, hey, if I'm tacking it on the end, it's a modification. And there's very specific things for modification. On government loans, it's 3 months right now. And I think for most lenders on conventional loans, it's 6 months, but you might not know when the 6 months starts. And the thing is, a lot of this was done in the background. So I've spoken to divorcing couples where I'm speaking to one client and we're working through it, and then I pull credit and I go, hey, your property was in forbearance. I can't refinance you for a certain amount of time. If you're selling, there's no big issues at all. And generally, you're not going to be evaluated on the loan that was in forbearance if it was paid off the same way you would if you were refinancing that same loan. So it's hugely complex. I think if you talk to 5 different lenders, they're going to give you different answers. And the best thing to do is plan ahead. So if people are mediating or going through mediation, as an example, plan ahead, get a lender in, let them look at your loan so that they know when you can get through all this kind of stuff.
One of the big questions that we kind of get in mediation goes along with that, kind of the chicken and the egg. A lot of people want to get the refinancing done prior to finalizing the divorce, but there's a lot of reasons why they have to finalize the divorce before the refinance can happen. Can you talk to that a little bit?
It's really situational again. I think the introduction of collaborative divorce and mediation have really changed it, because the filing gets pushed way back in the process. So you're almost filing and submitting a marriage settlement agreement simultaneously. It's pretty damn close. Where the old model was file and go through the negotiations, and then you're at the end of the process. The lending industry is everything's based on the old model, so it really makes it difficult. And every situation is different. So again, it's something of bringing in a realtor like Julius. I know he works with divorcing clients. A lender like me to understand that situation, your whole situation. If you have a house, you should be talking to both. You should be figuring out, what you need to do and when. And sometimes 3 different underwriters are going to look at it a different way. There's one I'm working on right now where generally I'm not able to get something done before people file. But let's say you've been living apart for 18 months, but you're not in a legal separation. You can sometimes still make that case. So, but to try and do it yourself is crazy. I know our site SplitReady is a lot about do-it-yourself stuff, and I think it's like anything else. You got to figure out what you can do yourself and what you really need to bring people in for who do not have a vested interest in one side or the other to give you that best advice.
I know there are things that you can do to, on paper, kind of speed it up, right? So if we have a good idea of what child support is going to look like early on in the mediation process, and we know it's another month or 2, maybe 3 of mediation before we're going to finalize it, can someone start paying child support? Does that matter if they see that
absolutely. Like there's what you typically see is a 6-month requirement of documented payments based on a court-ordered payment, which can be a temporary agreement. So yeah, I think with planning, you can shave a lot of time off the post-divorce. If you have to wait till it's completely filed and through the court and at least submit it to the court, which is usually what you have to see. If you've got 4 months of documented payments and then 2 months post submission of the marriage settlement agreement, that meets the 6-month requirement. It doesn't have to be the same amount. You're trying to show the willingness, the capability, and the ability to pay. So, I think planning ahead's always a good thing. And we were talking a little bit earlier about like just refinancing, and the other thing I want to touch on before we move on to talk about taxes is if you're going to buy a property right now, especially getting that pre-approval done, and I'm going to ask Julius about this in a minute, is really essential. And right now, if you want to have somebody have looked at your situation, looked at your documentation, really have done everything. I do with a lot of my clients, there's a report that I offer that they can get that really breaks down their entire housing situation to include if they're going to buy a home. And you've really got to look at that option as well and get everything set up for that in case you want to go in that direction. Because when you want to act on it, you want to make sure that you're not selling one house, trying to buy another house, and you really haven't thought about it and you think you're going to get approved. And Julius, I want to ask you with the lending side, how is that impacting the bid process?
Well, great question. Really, it's such a competitive market on most of my purchases now. Not only does the pre-approval have to be done, but I've also tried to ask for more proof that the due diligence has been done on the pre-approval, right? So, just stating that you've looked at their income statements, you've looked at their taxes if need be, you've looked at their credit. You just want to give that buyer every chance at being successful in a multiple bid situation. And if you're buying a single family house in the Chicagoland area, you almost have to assume that it's going to be a multiple bid situation. Otherwise, you will probably fail. And so, really making sure that the pre-approval is really tight, and that the loan officer, like yourself, I've had this happen where you've called up and put in a good word for somebody. You just have to be willing to do everything you can to prove that the buyer is really strong. And the pre-approval is really the first step.
No, absolutely. And thanks for adding that input, because I think, people are even at the point of writing letters again and doing that kind of stuff. So I think it's definitely an interesting market.
What about mediocre buyers, right? So let's say someone didn't pay some bills throughout the process of divorce, or there was some late payment. Like, what about the people who don't have the 800 credit score and what about those mediocre buyers? Are they just...
You're asking me?
Both of you, are they just SOL, or what's going on?
I'm glad you brought that up, because from a lending perspective, I see a couple of things. I usually see people's credit scores are lower than they thought they were going to be. And that comes from two real reasons. Either they're using what's provided free from their bank, or some of these other credit sources where they're looking, going, oh, my score is this. There's many different models in the credit scoring marketplace. And generally, those models are different than the lenders use. We use a tri-merged FICO model, and that is it's speaking another language, but it generally means it's a more stringent model. So I could sometimes see a 30 or 40% or 40 point difference in that. The other reason is one person's the money person and the other person wasn't, and things that have happened that they didn't know about. I can't tell you how many times I look and say, well, you got late payments, and they're like, on what? And they look and they didn't realize that. So they may find out they're a mediocre buyer. And the rates that are out there, when people see, hey, I saw this rate advertised, that's the best credit score with 20% or more down, and it's the optimal situation. It is a steep drop off from 700 to 680, and I can get deals done all day at 640, but there is an added cost to getting that loan, and I do think that's why it's really important to talk to me before you go and talk to Julius, because your purchasing power could be radically different between two different situations. The score you think you have and the score that you really have. And it's a unique market right now. I got in this business in the early 2000s when things were crazy, and that went for a long time. And I'm seeing the same entitlement, that people feel entitled to be loaned money and are taken aback if they don't get money at that best rate or money at all when they apply for a loan, when they don't stop and think, hey, this institution is lending you $250, $150, $500,000, huge amount of money, and they want to surely know that you can pay it back. There's a couple clients I had very interesting conversations with where they're like, well, I've always done this, this, and this, and why can't you just give me money without blah, blah, blah? I'm like, well, because that's just not how it works. So it is an interesting time, but it was a great point that you brought up.
Are you seeing something similar, Julius, when you've got multiple offers? Are sellers looking at the strength of the credit scores as well?
What I've found is that sellers are looking at, is there a realtor that they recognize? The listing agent. Do they know the buyer's agent? That's one thing that they'll look at. They'll also look at the pre-approval and say, well, is this a firm that I'm familiar with? Sometimes they'll do that. But really the detail of the pre-approval, they are, they're taking the time to read through it a little bit more. They're looking at the details and they're making sure that they don't have to sell the house twice.
So as a buyer in a challenging market, if you're a mediocre buyer, it just might be a little bit more challenging.
It could be, but a lot of times the pre-approvals don't show what their credit score. It doesn't show the credit score. So
Yeah, we actually don't even show rates on ours.
yeah,
It's definitely more for, I think that realtors and lenders will, I'm not going to say talk in code, but they can let people, they you have an idea of what kind of buyer you're working with where they're at on the pre-approval and things like that. And, there's a lot of scrutiny, I think. At least that's what I've seen when I'm talking to sellers agents and they're calling me, they're asking without asking. And it's just a really interesting market.
there are a couple of other things that you can do to make yourself stand out as well. I mean, even if your credit score isn't the best, if you have more down payment to make, you can, use that. You can actually raise your earnest money to a really ridiculous number,
Okay.
so that you have strength. There's ways to get around it, and it's really good to get with a realtor and have a loan officer and a realtor that work well together, and just have a very candid conversation about your situation. And there's ways to get around it. There's ways to make you successful as a buyer in this market.
I would not have thought of raising the earnest money, so I guess that's why we need you guys.
Well, yeah, I mean, I think, I've seen that too. And I think all that means a lot of times the earnest money is close to what the down payment is. So that seller really knows, like, what do they want it that much? And
Right.
yeah, it's, I think unprecedented has become a trivial, trite term when you're talking about this market, but it is crazy. And I think people, to kind of end the segment, I think people assume this will not change at their peril. I think what Julius was talking about, I work with a lot of investors. I think that they've seen this all before. And once forbearance ends, for real, right? Because they keep kicking the can down the road. I think you're going to see stuff begin to hit the market. I think people have done the mental calculus to say, if they're in that situation where they're going to lose their home, how long can I last? Well, I can last out forbearance. Then the foreclosure process takes a certain amount of time, and that could be 2 to 3 years by the time you get done. But I think people are also starting to think, geez, if I sold right now, instead of waiting, I could make, I think people think in percentage, right? They'll say, 5%, a 5 or 10% drop on my home, not a big deal. Well, it's $50,000 on a $500,000 house. So if you can nail it at the peak, why not do it and not trash your credit? Something like that. Great show today. And my dogs are going berserk, so I've got to end it because otherwise it would be the fun of podcasting from home. I really want to thank our guest, Julius Dickens. Fantastic realtor, great input. Dream Town Realty is where you're at, but if they want to get hold of you, how can our listeners get hold of you?
Sure. My cell phone is a great way to get a hold of me, 312-451-8894. And you can reach out to me via email at jdickens, JDICKENS @dreamtown.com. Thanks for having me today.
No, thank you so much. And I see a repeated guest appearances coming because I think you give great advice. So, what I would say is if you like what we do, not you, Julius, I know you like what we do, but if our listeners subscribe, share our information, share this podcast, check out SplitReady.com. There's great resources to get split ready, and know that if you're separating or getting divorced, that what the right way to go is, or at least what the right considerations are. So, Mariah, you want to take us out? It's been a while.
I don't even remember. You need to know what you don't know. So if you are someone that is thinking about getting split ready, or thinking about divorce, go to our website. And we really do believe that it is possible to move through your divorce with your finances, your integrity, and hopefully your sense of humor intact. And we want you to have access to the information that'll help you get there.
Fantastic. So thanks everyone for listening, and we will see you in May.